Hey, good morning, everyone. Marty Mazzora here. Thursday, May 12th, 2022. 45 minutes after the market open. Going to do just a quick snapshot for you folks. So we'll look at the 60-minute S&P 500 chart all the way up to the monthly, as we've been doing a lot of late. More and more, of course, I'm asked these days, how low do you think this can go? Have we seen the worst yet? Is it going to get a lot worse before it gets better, and so on and so forth? So we'll take a look at some levels. I'll add another technical screen to enhance our observation of probabilities and so on. So we'll do that probably on the weekly chart. So we'll start with the very short-term 60-day, 60-minute chart. And this one still suggests that a rally could occur. I mean, it's not bearish, frankly. It looks bearish. I mean, it's bearish. You have lower lows and lower highs. Yes, that's bearish. But we also have a falling wedge pattern, and that's bullish when we have bullish divergences. We have lower lows on the price chart, higher lows on the momentum indicators, the MACD and the RSI. You don't have a buy signal. You certainly don't jump in and buy because of this. You buy when you break above the pattern. So when you break above the downtrend with some momentum, ideally, then you jump in if you're a short-term trader, right? And you buy that. And what I would be doing if I were a short-term trader is I would be swing trading this thing once I found some support. And you kind of watch these things interact, but the key levels appear to be right here at 4,300 and wherever this thing begins to bottom out at. And I'm sure swing traders are doing fine if they're doing it right these days. But that's not what we're here to do, folks. But understanding this trading activity, say the swing trading as I suggested, also gives us some levels to look intelligently at in terms of support and resistance. So we'll see. Interesting setup. Could absolutely continue to break down. Lots of people suggest it probably will. Certainly the outside forces or the macro forces or whatever you want to call them are still on net bearish. I mean, we can find green shoots and glimmers of hope in certain data, but on balance, you should have low expectations in the near term, save for some really big, what we'll call bear market bounces that always occur as the market seeks out its ultimate floor. So on the daily chart, we did have this bear flag that I just drew up here yesterday, in retrospect, pretty good one actually. And then you take about the length of the flagpole, and that gives you your next price target. You can see that's probably about right. We kind of came in here, maybe flagged a little bit from there, and if that's the case, take you down to right about here, right where we are this morning. You can see we broke through what would be this support line. And well, on the daily chart, we also, for quite some time, had some nice bullish divergences. We've lost that on the MACD. Okay, so that's bearish. So that's broken down. You no longer have that going on. You do have a, you do have a wedge here, but you don't have a bullish divergence. You still have it on the RSI, and the RSI is about to dip into oversold territory. Notice here, and you can see it more vividly on the 60-minute chart, but here's a point where we got into oversold below 30, and we got a pop right there, right? And as we got close, almost oversold, little pop, almost oversold, big pop, right? And so we're there as well. We just don't have as bullish a look on the daily as we do on the 60-minute chart. Now I wanted to look at a 3-year weekly chart. Recall that I took us back 30 years and did this analysis, and based on the pattern that we're seeing here relative to the moving average here, that it makes sense that this market could find a bottom around, say, 3475, 3500 on the S&P. That would be very, very consistent with this kind of action over the past 30 years, except for when we're in recession. Right now, we're not in recession. Our assessment is that a recession is a ways off. There's a lot more people, as I think I suggested this week on the blog, that are calling for a recession this year. We may get there, but that's not our assessment presently. So without a recession and things trend the way we think they're going to, and we come down and we test this 200-week moving average, which right here is about 11% lower, that would be a place where we would begin probably scaling into some positions on the cheap. And because we're hedging with put options, particularly if this happens rapidly, we're going to have a ton of liquidity with which to do that. Doesn't mean we won't remain somewhat hedged at lower levels against something breaking here, because that's going to be a concern once we get there. And by the way, folks, once we get there, if it's truly a bottom, it's going to feel like the world's coming to an end, and the last thing people are going to personally want to do is buy stocks. That's typically a big sign of a bottom. For example, a friend of mine, we were walking into to play basketball the other night, and he knows what I do, and he said, my brother and my cousin and my sister, they want to buy Apple and Amazon and all this stuff, and they think they're super cheap. And I said, well, in this environment, when you talk to your brother and your sister and your uncle or whoever, and they say, oh my goodness, I'm getting out of the market, I can't take this, I'm never going to do this again, now's the time you want to jump in. If this is indeed a bear market, which we're like just a hair away from officially, which is a 20% decline from the peak, that's typically how real bear markets end. It's complete capitulation. Nobody wants anything. The last of the people who are going to sell, in theory, are out, and just a modicum of good news or no good news, and money starts coming in. The sellers are gone, and all that's left are buyers. Right now, we can see it in the ETF data that we track every week. There's still a lot of flows going in, lots of people buying the dip. So we're not seeing that. Now, this is a big move from where we are now. If we get that, I think there's a good chance we get that capitulation. Now, again, I have to say this probably for the third time this morning, unless we're in recession, if we're seriously tanking and the economy's in recession, we're going to have conversations about lower lows, and we're gonna stay defensive right there. That's not the base case right now. What makes sense to us is about, call it 3,500 on the S&P 500, and we're at 39.28 here. So more pain to come based on the longer term charts. Oh, that other layer I was going to put on here was just a Fibonacci retracement, respected technical indicator, and you go, in this case, you go to the COVID low, right? And I bring it up to the all-time peak, all-time high. Now, the key levels are of retracement. This is coming back down and retracing the rally. 38.2, 50%, 61.8, 50% being the one most seriously respected. Look where the 50% falls. The 50% retracement falls right on our target right there. And so that would be 50% from this rally off of the March 2020 low. So make no mistake, folks. Technicians who in the aggregate wield quite a bit of capital, they have that bullseye right there. There's also 38.2, which falls right at 38.15. That probably will find some support. You can see it looks like it has here on this weekly chart in the past. Okay, let me wrap this up. It's taken longer than I expected. So on our 30-year monthly chart, you folks have done this 10 times with you already, but this has been a really good signal. Historically, outside of a recession, you tend to test the 50-month moving average, which is about the same as the 200-week moving average on the time frames. That's a good bear market. Now, the average bear market historically is a 37% decline. I saw an analysis from a Bank of America analyst that said if this runs the course of an average bear market, it's going to go to 3,000, not 3,500. And it'll get there around October. So he was taking, the average in terms of the depth of the decline, the time frames, everything else. Most bear markets happen within the context of recessions, though. And so this one, if it's an out of recession bear market, and they're rare, but if it is, we think it may not get that bad. If we're in recession, we think it gets that bad or worse. So I hope this all helps. More than anything else, I just want to kind of stay in the heads of our clients. Let them know that there's nothing happening today in terms of the price action that's all that unusual. I mean, markets go through corrections, they go through bear markets. What's unusual is the inflation that we're seeing and the structural changes that I've written volumes about on the blog that demand that we do things differently going forward. We don't think buying, FANG stocks is going to be the secret to long-term success going forward. We think that buying resources stocks, things that are going to feed the big global push to green energy and all the other things that we've talked about. We think that we want to own some of the traditional things, the technology, of course, and we definitely want to own defensive stocks right here. And we want to own foreign stocks that pay twice the dividend and are way less expensive than US stocks. We think there is serious upside potential in what we're doing, frankly, over the next 5+ years. The next 5 months, flip a coin. This is a very volatile period. I'll leave it there, folks. Thank you very much for watching and listening. Should be tomorrow that I come to you with the economic update video and maybe another snapshot of the market as well. Take care. Have a great day. Bye-bye.